when you're looking at Apple, when you've seen some of the weakness, the worries about product updates, about perhaps behind the curve when it comes to AI, is this still such a solid name that you cannot avoid but to remain allocated to it, or do you start to take some risk off?
It's a great question, Caroline. So, when we look at Apple, it is a great company. It's got a high-quality balance sheet. There's so much cash on their balance sheet, and that allows them to buy back a lot of stock. It's a big position within the S&P 500 index, so it is difficult to not own it, and yet we do start to see some of these issues with Apple in terms of innovation and them being able to really bring new products that can continue to grow at the pace that they have been growing over the last several years.
And I think this is some of the tension we're seeing across the so-called Magnificent Seven, those that are deemed less than magnificent, for some still managing to do very well. When we're worried about a Tesla and Apple, which in many ways have very similar issues, China weakness, competition coming from China, worries about ultimately a lack of an update from a product, is it more, therefore, you have to look at valuations rather than trying to see a narrative as to when you get the next product?
I think it's the combination of both valuation and then just future growth. I think both Apple and Tesla are suffering from, the issues that you talked about, and that's dampening their overall growth going forward. And so valuation for that lower growth is a little bit higher than everybody would like to pay.
Ayako, if the mega caps don't beat, what happens?
I think there could be a little bit of another sort of sell-off in the market. We saw it last week and a half, ever since the inflation print. And I think we do need to see a lot of these larger names, Microsoft, Amazon, Google, Meta, they need to come out and show us that they can continue to grow at the pace that they can grow and show that free cash flow growth so that people can continue to rely on them for that quality growth.
Do you get the sense, Ayako, this is the quarter where we look past the AI hype and we start again to look at fundamentals? Did you have earnings growth? How is your free cash flow? Traditional, boring things like that.
I think it's going to be a combination of both, Ed, in terms of, you have to produce those numbers. Those fundamentals are going to matter. But everybody wants to look at the future and say, well, can you continue to produce those quality numbers that we've seen? So AI continues to be, a tailwind that everybody wants to see production out of and further continuance of that revenue and earnings growth.
When you are seeing such a run-up in big tech of late, how much are you thinking about the macro, thinking about the data that we got today?
Oh, absolutely. I think the macro always contributes to the overall market narrative. The larger cap names just tend to be at the very top of the funnel, per se. And they are technically those long duration assets that everybody likes to talk about and are most impacted by higher interest rates. And so they are a crucial part of how we look at the overall macro as well as the individual stocks.
Let's do a case study, which is Spotify. It's an interesting subscriber and ad-based platform, profit and user growth. What does that tell you?
Spotify's been on quite a tear over the last year. They've really focused on managing costs. And, as, everybody's seen with the results, those gross margin numbers were really eye-popping. Seeing those, the guidance for gross margin to continue higher at 28% next quarter is definitely something that we can continue to see with Spotify really, generating that revenue and the earnings growth and managing the costs while they do that.